Hey, what's going on, guys? So today is my day to update the portfolio. I do that every month on the second. This is the second video for this. Last month, there was a question as to whether we should buy more of a utility stock or more of a real estate stock. And this is the real estate stock here, EQR, and here is the utility stock, XCL. So this month we have what looks like a lot of sale recommendations. So I'm going to take a look at these today, and also the buy recommendations. I'm not going to do anything with the buy recommendations simply because the only one that has any significant upside for it is right here, the BCE. And it's a telecom, and I think there's a bit more downside left on these. And it's, if I buy more now, I'm only looking at a 3.3% increase. I can definitely wait for this to come in just a bit more, maybe get that number up to 5% before I buy any more. So our purchase price is 47, and it looks like right now I think this thing is like at 43, 44, not sure. Let's take a quick look here and see what we come up with. It's the telecom. Uh-oh, wrong button. All right, there we go. BCE. Yeah, current price is 43.19. So we're gonna wait for that to come in just a bit more, maybe around 41.40 would probably be optimal without actually doing any math on that. But I am gonna look at the sale recommendations though, and just see if maybe there's a better place we can be as far as these particular sectors. So McDonald's is going to be consumer cyclical. ExxonMobil is going to be energy. Sunlight Financial is what we talked about last month. That's finance. And Seagate, even though we have a sell recommendation on this, can't sell it quite yet. We have to wait till next month before we can do anything with that. But so we're looking at McDonald's, ExxonMobil, and Sunlight Financial. Also, too, what I want to take a look at is see whether or not I made a good decision last month on buying more of the utility stock versus the real estate stock. So let's take a look and see what the performance is. All right, and let's do this. Go ahead and filter that. See, we just need the finance, no, sorry, not finance, utility and real estate. There we go. All right, so last month we were looking at this thing, and real estate was sitting at a 5.9 average. January is doing better than 3%. Utilities were negative last month. This month 6%. So just on a sector basis, definitely came out better going with the utility. Now looking at the individual stock here, see EQR we have here. January was 526. The utility XCL 568. Okay, on average XCL is up 7.3. I'm sorry, 0.73. EQR is negative average for the year. So I would say that I came out much better going into the utility versus the real estate, even though they were very, very close to each other as far as returns for the month. And but again, as you can see, the average return for utility in January versus the average return for real estate stock for January was drastically less. So I think we did pretty good there. What I'm going to look at now is exactly what portfolio performed the best in January, or I should say in December. January is the date that I do this stuff on. And it looks like, I don't have this thing, beta, return, and alpha. And that makes sense. You know, you got a lot of return, got a lot of alpha, and with a bit of beta thrown in. And beta seems to perform best when the market is not doing so well. I'm kind of curious to see what was the next best performing portfolio, and it looks like it was this one, return and alpha, of course. So return, alpha, and beta. Pretty sure those two portfolios are probably really close. Let me go ahead and freeze this just to make things a little easier for us. All right, and see, beta and alpha was really close. Beta and return were really close, of course. And looks like those were the best. So it looks like, again, just like last month, the return and the alpha stocks are really doing the best. Looks like most of the portfolios were down this past month. And so I'm sure that's the reason why having a bit of beta going into the portfolio really helped out. But again, it looks like there was a tie with return and alpha. So with that being said, I have to say then that it's the return alpha and not the beta return alpha that probably performed best. So what I'm going to do is I'm going to take a look really quick at those portfolios, return and alpha and beta return alpha, and just see what the difference is in those particular portfolios. So dividend down equal, that's beta return, beta alpha, beta down, looking for a return. Here we go, return alpha. So we got Microsoft, L brands, I forget, LLYs like Lilly or Eli, no, not Eli Lilly. I forgot what that is. What's the health stock? Dow, Paychex, MO, VLO, EQR made the portfolio. Isn't that something? All right, MFC, that finance stock we're always looking at. Dominion for the utility, Verizon, telco. All right, and so the next one is the beta. Wait a minute, was that? Okay, it says return in alpha, but it says return up here. I don't know why. But that is return in alpha. Yeah. Alright, so beta, return in alpha. See if it's the same. Beta return and alpha. Here we go. All right. Yeah, pretty much. L brands. Instead of Dominion, this one has XEL, and of course that's because of the difference in beta. I'm sure Dominion is probably a higher return stock. Paychex, LLY still there, Valero still there. The finance is AFL though. That's interesting. AFL is the best in the sector at the moment. Verizon and then Dow. So as you can see, they're really close as far as portfolios with some small differences in the portfolio. And so again, that lets me know that what's going on in the market right now is a play more towards the return in the alpha stocks. So those are stocks that have really high returns and tend to move up when the market moves up. Beta is, you know, when the stock moves up when the market moves down, right? Alpha, beta, opposites. So anyway, what I'm going to do now is I'm going to look at what we have here over the past 12 months as far as what stocks have been the best of the best or what stocks have been in the portfolios that are best of the best. Uh, Staples, Best Buy, McDonald's, L Brands, Best Buy. All right, so what I'm going to do is I'm going to count this. Let's see how many McDonald's we have here. 1, 2. Wow. So looking at McDonald's, there's only 2 here. And I mean, it scores the best of the best um, in the consumer cyclical sector. It actually has the best score out of any stock of all these. But month after month, it is not the best in the portfolios. So let's see what made the cut. Let's look at Best Buy. 1, 2, 3, 4, 5. Best Buy comes up 5 times. And let's take a look at L Brands. That shows up quite a bit. So we got L Brands 1 time here. 1, 2, 3, 4, 5. So for right now, L Brands and Best Buy are basically tied. So what I'm going to do is I'm going to go and look at L Brands and Best Buy along with McDonald's, just to see which one is has the highest return, since that's what seems to be working right now. Of course, I am deathly afraid that we're going to see a big correction sometime in 2017. I'll be holding on to these high return companies, which can really cause some issues. But let's see where we're at. So L Brand scores better than Best Buy for sure. Best Buy is down here at the bottom. But again, that is based on beta stock. I think beta versus volatility, actually. So if we were to switch this around to a return, I'm sure they'll come up better. But we can't do that until June, or July rather. All right, so I don't have ratios, or all the ratios rather, for Best Buy or L Brands. So let's look and see what we do have. So the PE for McDonald's is 22, L Brands is 16, Best Buy is 12. So right away, L Brands comes out looking a little better. The volatility though for McDonald's is very small, and that's a good thing. You know, we like that. It means that the stock won't move very far, very fast, but yeah, it won't lose a lot either. And Best Buy is, look at this, 14.7. That is high. All right, average 1 month return: McDonald's 0.45, L Brands 1.77. My goodness, that is high. And even Best Buy is double of McDonald's. So that goes to show you that L Brands packs a punch as far as returns. Dividend is actually higher for L Brands than McDonald's. I like that. Let's see here. As far as price movement goes, I'll have to look at a different chart for that. But I'm going to rule Best Buy out just automatically, looking at that teeny tiny dividend, 2.6. I definitely wanted something a little more than that. And being that L Brands, you know, scores better than Best Buy, I think I can just cut that one out. So we're looking at now the difference between L Brands and McDonald's. And again, so the idea is I will sell McDonald's and buy L Brands. So let's look at their performance over the past while here. All right, so here we go, McDonald's and L Brands down here. All right, so on average, L Brands is 0.43, McDonald's is 1.33. L Brands lost 8% in January. My goodness. Let's look at December. Gained 8, McDonald's gained 5. See, L Brands lost 4, McDonald's lost 2. L Brands lost 5, McDonald's lost 2. September, or it's really August actually, McDonald's lost 0.04. L Brands beat them out. L Brands beat them out again in August. Well, I mean, look at this. From what I can tell, it looks like, oh my goodness, it looks like McDonald's has beat L Brands for sure as far as performance goes over the past year at least. And so that gives me some ammunition to definitely stay with McDonald's. See, what else can we look at? I am curious as to how they score, and I didn't look at that the first time. Let's see here. Looked at the PE ratio and the volatility, but I did not look at the actual score. So I'm curious about cap cost. Both of them 0. All right, here we go. So L Brands actually has a better beta. My goodness, it has a better beta. Let's look at this alpha. Since I'm here, expected return 19 versus 5. All right, this is here we go. Alpha -1.7, -9. My goodness. Yeah, I mean it looks like L Brands is where you want to be, but golly, based on the past performance, that's a tough decision. Okay, so this is movement. All right, so when the market, no, I'm sorry, when there's a lot of activity in the stock, 19% of the time, L Brands moves up, McDonald's moves up 15%. When there's a lot of activity in the stock, 85% of the time, McDonald's moves down. L Brands, 23% of the time, moves down. And so what that means is, I mean, 100% of the time, McDonald's has more and more activity as far as shares trading back and forth in the company. L Brands, not so much. So lots of activity means lots of back and forth, which stabilizes the stock price. That's why the volatility is not as high as L Brands. L Brands obviously has not a whole lot of activity, less than McDonald's anyway. But what's important here is both times it's the stock price seems to move down when there's a lot of activity versus moving up. So I mean, just looking at the scores by themselves, if you don't include volatility, I mean, L Brands beats out McDonald's all day. This is the other thing that's interesting here. The L Brands is 50% off of its high for the year and only 9% off of the low for the year. And McDonald's is the complete opposite. I mean, this is for sure I mean, a complete opposite trade. It really is. I mean, these guys are not the same. So what I'm going to do is I'm going to have to do some research on L brands um, to see exactly what happened last month, if anything, to cause that big 8% drop. Because it's very possible that that 8% drop is what brought L brands so close to its low for the year. And I mean, if it's something simple, maybe an overreaction or something like that, well, that's a decent buying opportunity. It really is. However, if that drop was because of earnings or conference call or something negative going on with the company, that's something that I want to take into consideration. Definitely don't want to go from a good situation to a bad situation, right? Um, all right, what else are we looking at? I think that's it for the night. I really like paychecks. Love paychecks. Can't wait to get into paychecks, but I got to get out of my current position in GE before I can move there. Yeah, that's it, guys. All right, well, like I said, I'm gonna do a little bit of research on L brands, and I'll make my decision on whether to buy L brands or hold McDonald's. So until next month, I'll holla. All right, so I still have the energy and the finance to look at. So let's do that really quickly here. It's gonna pull up all the stocks in the energy sector. See what we come up with. And again, I'm almost certain this is going to have to do with the same thing. It's going to be beta versus return, just like it was for consumer cyclicals. So we got Exxon over here. Current price is 90.35. See, the return. Well, actually, you know what? Let's go and let's look and see what was actually the best in the sector and go from there. All right, so let's do a quick count here. So yellow is the energy, and just kind of looking at this thing, looks like MRO, VLO. Yeah, MRO and VLO are the best. Got a couple ETPs in there, so let's do a quick count. All right, so MRO, we got is ExxonMobil over here? Yeah. All right, MRO, we got one, two, three, 4, 5, 6, 7. All right, how many VLOs do we have? VLO, yeah, it's just a couple actually. 1, 2, and as far as ETP, it's like there's only 2 of those. ExxonMobil, only 2 of those. All right, so let's do this. Let's go find out. Oh, we already know because we looked at this before. This is the no, MRO. Sorry, MRO is looking for the yellow highlighter. MRO is part of the equal portfolio. Yeah, I don't believe that one. Let's look at a different one. Let's look at this one. Let's see. Yeah, actually, MRO is part of a bunch of different portfolios. I mean, this one is the same, but that's different. That's different. All right, so let's do this. Just highlight all of these, and we know for sure number 14 is not MRO. And let's see what portfolios those are. Alright, so alpha, standard deviation, which is volatility. So that's a return minus volatility. Alright, and we got down movers and we got volatility. Well, you know what? It sounds like this thing scores in the portfolios best for volatility. And also this weird little category here called the down movers. And what that simply means is that when when there's a lot of activity in the stock, the price moves down. And what that typically means is that when there's a lot of activity, there's a lot of selling going on, not a lot of buying. That's indicative. I'm not saying that right. Indicative. There we go. That is indicative of a company that people are trading out of, right? They're going in, they're making money, and then they're trading to get out of it. So they sell to make a profit, right? And so when there's a lot of activity, there's a lot of people selling to make a profit. So again, let's go and let's look at the past performance and see exactly what's been going on. No, table. There we go. Energy. All right, here's MRO here, and really great return, 0.91, second best in the sector actually. ExxonMobil's here at 0.32. Look at this. See this? In December, 35% return. That's crazy. ExxonMobil lost. January came back and beat them a little bit. And see, in this negative here is probably only people selling to make this profit. So, you know, the stock probably didn't move down. It probably just a lot of people selling to make a profit. And that's why you have that loss there. But let's take a look at past performance and see what's been going on. All right. So one there, lost there, one there, lost there, one there. So, I mean, of course we know overall, right, that MRO beats out ExxonMobil. But what my concern though is the volatility. You know, it's the volatility. That's a big drop, which makes for great buying opportunities. You know, so let's go back and let's look at how this thing scores, because I'm a little confused as to how we can see this much up and down in that stock, but it scores so well for volatility. That's kind of weird. Let's look here and let's see what we have. Volatility for Exxon is 6.6. For MRO, which is way down at the bottom, because ExxonMobil scores so much better than MRO. See, volatility, 12%. That's a big difference. Let's do this. Just get rid of these real quick, since we're only looking at these two. All right. PE, don't have one for MRO. Net profit, Exxon comes out better, of course. Current ratio, ExxonMobil comes out better. Wow, cash on hand, MRO, much more cash. MRO putting on assets or getting rid of liabilities, one or the other. Interest expense much lower, well not much lower, but lower anyway. Beta is smaller. Curious to see where we are on highs and lows. Looks like the expected return is negative for all of these, but less for ExxonMobil, of course. And so you see here's the score, 0.05 versus 0.02. That's like double. Exxon score is much better. All right, so ExxonMobil is 1% off the high. MRO is 19% off the high, but 95% off the low. So what that means is this thing obviously skyrocketed up and then came back some. And so the question is whether or not it has more room to go. This is always a weird one for me. This is basically saying that it is way above the high. So we have E minus Q. So the high target on it is 31. And let's see where the price is. Sorry, computer, making you work too hard when you got the video going. Alright. Current price is 38. See? So that's way above the estimated price that we have on that particular stock. And anytime it goes way above what you estimate, that definitely gives you some pause. So anyway, going back to this. All right, so 1% off the high for ExxonMobil, which means that 1% more, it hits where we estimated that it will go. MRO is 19, 95% off the low though. Alpha is -3. For ExxonMobil is -2. I don't know again how MRO got into those portfolios. I'll go and figure that out here in a second. As far as moving up, yeah, 35% up, 19 up. Again, that's just because MRO is a stock people are trading in and out of. But again, that can be a good thing. Curious what the dividend is. MRO is, oh, never mind. Look at this. No, never mind. Conversation over with. Why didn't I look at that first? My goodness, 1% versus, ExxonMobil at, really, more than 3.3, because this is 3.3 based on the current price, not the price I purchased it at. If I got out of ExxonMobil at a 3% dividend and got into MRO, I'll be losing 2%. So again, MRO looks like something that'll be a decent trade. Maybe I'll do something like that in my personal account. That's a stock that I'll definitely look more into, especially being that it's so cheap. My goodness, you can buy a lot of shares at $17 a pop. That's cheap. So all right, so we're done with that. Let's take a look really quick at finance. I did this stuff last month. I don't really think anything has changed much that's going to change my mind, honestly, on this, other than the fact that I did see AFL show up again, and that really gives me reason to look at it, honestly, because it scores the best in the sector. It scores the best in the sector. As far as what has performed the best, let's take a look here. Finance. SLF beats out everyone, other than, MFC is really close. But yeah, look at this, AFL. It's just, it's the past performance just hasn't been great for AFLAC, and Again, it scores the best in the sector, but the performance just hasn't been there for whatever reason. And just looking back a couple months here, yeah, looks like, well, recently, actually, AFLAC has outscored, not outscored, but outperformed Sun Life. Really has. That's most recently. So what I'm going to do is I'm going to have to start looking at this average. Maybe instead of a year, maybe do another average for like 6 months or something like that, to really see the difference in these things. So, but I'm not gonna do that right now. But yeah, I mean, AFLAC has outperformed, no doubt. Let's look here. Yeah, lost there. Definitely lost some ground there. Let's look at this. Right here. Yeah, I mean, I'm not surprised if maybe this big jump here is what made all the difference for this average for the year, for sure. And we can actually do that. Let's see here. If I were to do that and do that, see what we get. Yeah, AFLAC outperforms. So now that we know that, I can't help but take a second look at this thing. So let's go and let's look at the portfolios that those two are in. So let's look here. Got AFLAC there. Yeah, no. it hasn't been part of the best performing portfolios for whatever reason. Let's see here. It beta return, standard deviation. So volatility, beta, and a little bit of return basically is what this comes out to. So less volatility, better performance when the market is down, but overall decent return. As far as the one has performed with the best portfolios here, we got SLF once, twice, 3 times, MFC once, twice, 3 times, 4 times, and again, we kind of looked at this stuff last month, and I decided to stay in Sun Life. But you know, now staying in Sun Life versus MFC, that is. But I can't help but look at this AFLAC now. So what I'm gonna do is, and before I do that, let me come here and take a look at the dividend, because that has been the difference so far in all of these. So AFLAC 2.4, Sun Life 3.5 probably. Again, I'm losing a full percentage point on that. AFLAC performs better. You know what? This may be one of those times that, man, this is hard. Let me see where Sun Life is versus, so yeah, better return, volatility better, PE better. Net profit, of course, beat them out of much more cash on hand. Better asset management. Paying a bit more for their debt. Beta is better. Let's see, I got a target of 78.98 on AFLAC and 47.45 on Sun Life. Man, I'll be honest with you. Sun Life going all the way to 47. That's hard to see, but who knows, right? Low target on Sun Life is 30. Which that's about right so far. Expected returns, negative, positive. Let's see here. All right, AFLAC is 12% away from its high. Sun Life is 20% away from its high. 33% off the low, 26% off the low. Alpha is better. Up moves and down moves are better. It's difficult, man, you know, because what happens is when I'm in a position to sell Sun Life, everything else in the sector is up, you know, and I definitely don't want to be out of any one sector at any time. So it's tough. It's tough. What I may have to do here, it's tough, man. I think I'm gonna stay with Sun Life. I mean, you know, I kind of already made up my mind on that anyway. You know, it's been doing the best in all the portfolios, better than AFLAC anyway. Dividend is better. It's been really putting up some great numbers. AFLAC definitely has its benefits too. Again, I do a bit more research on this, but for right now, I think I'm going to stay with Sun Life, especially being that everything in the finance sector is really up right now. So maybe it's possible that I'll keep a sale on Sun Life somehow or another and have AFLAC come in. I don't know how that's possible, but you know, it'll be nice if that happens. All right, so I think that's it. I went through everything. Got to do some more research on L brands. Going to do some more research on AFLAC, but definitely more on L brands than anything else. Exxon, we're definitely going to stay due to the dividend. Sun Life Financials, you know, as of right now, definitely want to stay due to the dividend. So the only thing that I really have to really look at again is this McDonald's versus L brands, and just so I'm clear, let's look again real quick and see the dividend on L brands versus where McDonald's is. I think they were really similar, actually. Let's see. McDonald's 3, L brands 3.6. Man, yeah. So what I'm gonna do is I'm gonna do my research on L brands, and if I like it, I'm gonna get out of my McDonald's and move into L brands. Period. That simple. That easy. All right. Holla. All right, so I did my research, which primarily consisted of reading some news articles and going over some analyst reports. And what I found was the reason why AFLAC, even though it has decent numbers, is not going to perform as well as some of the other financial stocks, especially in this time of day, is because AFLAC is primarily based in Japan. That's where most of their business comes from, and a lot of their products are simple insurance products like accidental death and dismemberment. So even though the interest rates do give them a little bit of help as far as being able to meet their goals and put a little extra on the side, they aren't making a lot of money. Those margins on those simple insurance products are not very high. Unlike Sun Life Financial, which is doing like retirement and mutual funds and all that kind of stuff. So that's what's going on there. Now, as far as McDonald's versus L Brands, again, I did my research there, and what I found out was L Brands is basically Victoria's Secret and Bath and Body Works. Now, Bath and Body Works is doing just fine. However, Bath and Body Works is only about 35% of the total business of L Brands. The majority of the business is going to be Victoria's Secret. And where is that at? That's here. There we go. Yeah, the majority of their money is coming from Victoria's Secret, and as we all know, no one is shopping in stores and malls like they used to, and so that's a lot of the reason why Victoria's Secret started off at $93 December 31, 2015, is now down at $66. That is a glaring issue that I saw but didn't pay a lot of attention to, so I'm glad I went back and did my research. This thing has lost a lot of money. I mean, literally a third of its value just gone, vanished over the course of a year. And that's also why L Brands is probably outperforming McDonald's right now, because this $66 is probably a bounce. A lot of people are looking for the bottom so that they can, dive in and buy it real cheap and wait for it to go back up. So I'm sure that's what's going on. Yeah, not something I want to be in. Another story that I read which was interesting was this new thing called bralettes. Now I did talk about this on Facebook, and I didn't get anyone to reply or comment on it. So I don't know if this thing is really popular or not. Maybe it's just someone trying to sell something. But the idea was that bralettes, which are bras made with our underwire, are going to replace the traditional bras that Victoria's Secret sells, and that's another reason why it's possible that the price has gone down as much as it has. I don't think that's the case. I think it's just the whole mall thing and people not going to stores as much as they used to. So anyway, staying with McDonald's, staying with Sun Life Financial. I holla.